Today I want to speak to you about the stock market and as it relates to midterm elections. Obviously, in 2022, we have a lot of factors contributing to stock market volatility. We don't need to go through the laundry list. This is specifically related to what markets historically do leading up to and after midterm elections. Now, if we look back over 85 years of history and 21 prior midterm elections, there's only been 2 years where the president's party has gained seats in the House or Senate, and that is highly unlikely to happen this year, as has been widely reported up to this point. The second interesting fact is year 2 in a president's 4-year term has historically been the worst in terms of stock market returns. In fact, if we go back and look at the S&P 500 from 1946 through 2021, we find that the average return of the S&P 500 in all years is up 8.95% a year. In midterm election years, it's up 5.01%, and in all other years, it's up 10.25%. Now, what typically happens leading up to the midterm elections is uncertainty. And stock markets don't like uncertainty, so typically expect in the 2 to 4 months prior to an election, you will see increased volatility in the markets. Now, that's not being widely reported right now, as there's a lot of other factors contributing to the current stock market volatility, but you can anticipate that as we get closer to the elections and the end of summer. But what historically happens when you get very close to the election, you tend to see a stock market bounce because there is more known, more certainty. And after the elections, the stock market tends to recover the losses leading up to an election 91% of the time before the end of the year. And if we look at the S&P 500 going back to 1950, the average 1-year return after a midterm election is up 15.1%, which is almost double that average return in all other time frames. Now, what can happen in 2022? There's 3 main options. We know the Democrats retain the White House. So one is Republicans win either the House or the Senate, which would limit major changes to taxes or spending. 2 is Republicans win both the House and the Senate, which would present strong headwinds to any of the current Democratic Party's agenda. The third is Democrats retain the House and the Senate and controlling all houses and branches of the government, which would mean they would push through most of their agenda items in the next 2 years of Joe Biden's term and would certainly push through the remaining items of the Build Back Better bill that have not been put into law yet. So what historically happens to markets in these various scenarios? Since 1930, according to Y charts, the Dow Jones Industrial Average, when one party controls all branches of government, Dow Jones has averaged 10.7% a year. When it's a split Congress, Dow has averaged 9.1%, and when the president is in the opposite party to the House and the Senate, the Dow averages a 7% rate of return. Now, these numbers change and fluctuate based on who's in control of what branch, but those are averages overall. And so, historically, stock market and elections, there's a lot of short-term volatility. The state of the economy is a much greater factor in what happens to markets than what goes on in elections. We cannot ignore politics, but market results are rarely as bad as that will get portrayed in headlines leading up to these elections. So what you want to do is make sure you don't rely on headlines to make investment and portfolio decisions. There are many factors that will impact what happens to markets. Short-term volatility, as always, should not impact your long-term strategy, your financial plan, and your investment decisions. And also be careful not to impart your own political beliefs and biases into what you think is going to happen in the stock market. Very rarely does that actually work out or happen. Thank you. We appreciate your time, and make it a great day.